Most people realize by now that he is a firm believer that the borrower is a slave to the lender. Because your most powerful wealth building tool is your income. When you haven't committed your income in the form of payments to everybody else, you can invest it and become wealthy. The average car payment in America today is $503. That's just crazy, he exclaimed. If you invest 500 in a decent growth stock mutual fund from age 30 to age 70, you'll have over $5 million. That one thing will make you worth $5 million, isn't that amazing? He has become known for getting people out of debt, and it changes your life. It changes your family tree, and in your retirement, you retire with dignity. What is amazing to him is that almost the entire financial industry focuses on one part of the equation, and that's the investing part of the equation. They all have a bunch of theories. He had all the letters and licenses after his name. He has a degree in finance, and he had all the licenses and the businesses. It is amazing the number of people in the financial world, whether they're financial advisors, writers, bloggers, whatever they do, that have opinions about money, that don't have any money. Whose track record on teaching people to invest and getting them to invest suffer? 3% of the public is where all of those people make their money off wealthy people. They make all their money off wealthy people. Also, most of the advisors out there won't fool you if you don't have some money. They don't want to sit down and talk to you, and so we start teaching people all these years ago how we invest, and then as we've met with many thousands of millionaires over the years, how they invest. What are they doing? He is personally investing in good growth stock mutual funds. He spread it across 4 types: growth and income, growth, aggressive growth, and international. He buys mutual funds that have at least a 10-year track record. If you want index funds, basically an S&P 500 fund mirrors the market that basically is the stock market. You have to follow what the stock market is doing, whether it's good or bad. He is buying funds that outperform the market. All the data says a decent portfolio of good performing mutual funds wins. The big thing is actually putting money into the mutual funds. It is actually investing. One piece of research shows that 74% of the reason for retirement success is doing it. It is called the savings rate, the number of money that you put in versus you talk about it. Continually put money in year after year after year, year after year, month after month, week after week out of your check into your 401k over and over again. This is how you get wealthy. He knows a lot about mutual funds, and he picks mutual funds about 80% of the choice on his mutual fund 85 based on its rates of return. If the track record's tied, he will look for the longest track record who's been doing it. A long track record is something stable. There are all kinds of names for mutual funds, and the name of the mutual fund tells you what is in the fund. A growth and income fund is also called a large cap fund, sometimes also called a blue chip fund. The blue chip is the most expensive chip on the poker table, so that means these are big companies. It means these are large companies, and so your growth and income funds are large companies. Of the 4 types of mutual funds that he put money into and he recommends, this is the calmest. If you were to chart this volatility on this fund versus the stock market, you would see it's a lot calmer than the market, and so it's your friend when things are going down. Why is it not doing well when the rest of market's going up? Because it goes slower than the market up and slower than the market down. Because it is a stable land. A growth fund is right in the middle. The S&P 500 index fund would be considered a growth fund. A growth fund is companies that are growing. They're kind of medium-sized companies, so you might hear it called mid-cap fund. These are just standard growth stock mutual funds. There are a whole lot of these out there. A ton of funds fall in this area. The idea is pretty simple. The growth fund, that's kind of right there in the middle. You want something in the middle. It's pretty much going to do about what the market does in terms of volatility. But you can get mutual funds that are growth stock mutual funds that outperform the S&P 500. You can even get growth and income funds even though they're not as volatile that outperform the S&P 500. Then, there's the aggressive growth fund. This is the wild brother. It is also called a small cap funds. These are the small companies. The startups and a lot of tech companies would fall into there. The crazy stuff is in there. That means some of it fails and goes to zero, and so it's a crazier mix. It's going to be much more volatile than the stock market is. Basically, it's going to go up faster than the market goes up, and at the same time, it's going to go down faster than the market goes down. Small cap aggressive growth stock mutual funds, also known as merging market. International funds mean that the stocks in it are overseas companies. It is like being related to global fund. American companies generally outperform other international companies by and large as a group, and your international fund will be your worst performing of the four over the last several decades. On the other hand, a global fund will outperform an international fund because you put some spice in there, you put some American companies in there usually. So they're a little bit better, but at least you got some stuff overseas. You're not 100% betting on the American economy, not that he is anti-American. He is not. This is a diversification thing, and so you want to have some BMW, for example, and or some Mercedes in there. You want to have some LG and some other stuff, even though some of those things are made stateside. It could be a French company. It could be whatever is an international fund, and then you spread your investments across those four types. It is very simple here. The important thing is, do it. That's the thing. Everybody likes to talk about investing, but the problem is, nobody does it. People we talk to on the millionaire theme are millionaires, and you may be thinking, how they got to be millionaires? Simply, they did it. They never want to be asked how they become millionaires. They never say, man, I hit the home run. They never say that because it never happens. His golfing buddy gave him a stock tip. He doesn't meet millionaires that did that. He hears stories about it. But a golfing buddy with a stock tip is like a golfing buddy with a fishing story. The one that got away. It's just that everybody's got an opinion. You just have to really stop and go slow and steady. Actually, investing is the way. It is the way. It is the only way to go. So growth and income growth, aggressive growth, international, don't chase the returns. Do not invest money in things you do not understand. People get ripped off when they invest money in things that someone told them are good and they trusted the person instead of knowing what the flip they're doing. Look at all of these athletes you read about. The NFL stars and they lost $10 million or they made $100 million and it's all gone? You know how they lose their money because they give it to someone else to handle? They don't even look at it and then they're shocked to find out that person was a crook. That's how you lose your money. It is your money. It's like your kids, which means you have to make them behave. You have to understand it how and now. You don't have to have a master's degree in finance. The truth is not rocket science. It is really not that difficult. You really and seriously have to do this and you have to understand what the money is going into. Do not put money into that. For example, when you're buying insurance, when you're getting a mortgage, doing your investment in mutual funds, that's why when you do all of that, you have to understand what you're doing. And the only way you're going to do that is when you're picking someone to help you in one of those areas. You're doing your estate plan, and if it's complicated, you're doing your taxes. If they're complicated, that kind of thing, you need someone sitting on the other side of the table that is not a salesperson, but they have the heart of a teacher, not the heart of a salesperson. Timing is everything when it comes to investment. Patience is key for new investors. Long-term investments are more likely to yield higher gains. That's because your investments need time to grow. They also need time to adjust to the ups and downs of the market. There is a lot to learn when you begin investing, and no one starts out as an expert. Even the greatest investors started with limited knowledge. Word of advice? If you really are interested to invest in something, pause and think of your future. Pray about it and start with small. Remember, no one started big already. You have to go through the process so that you will enjoy the benefit of that decision when to invest.